the U.S. has got to raise a hell of a lot of money in the next 2 years. So who do they sell this stuff to? I mean, I see articles every day on the Treasury market, and one of the things they really talk about is who are they going to sell this stuff to? This is pretty much your list of suspects, in my opinion. China, world's biggest foreign reserves, are actually over $2 trillion now. They're still sort of willing for now. I'll go into that in a minute too. Japan is actually quite willing. Japan's always terrified of having their yen appreciate too much. They're quite happy to trade yen for dollars and play along. The Eurozone, they got their own issues. They've been a reasonable sized buyer of treasuries in the past, but I think they're not that crazy about doing that trade at this point. Russia, of course, they've got issues. Taiwan's got issues. India, they've had to defend the rupee a little bit, and they've never really been big buyers of this stuff. Brazil's defending their currency. South Korea's defending their currency. There's probably another $1 trillion in private funds and basically funds like Temasek, which is the government investment fund in Singapore. There's probably a dozen funds like that around, mainly in Asia and the Middle East. They probably got a couple of trillion. They've been reasonably large buyers, but I think most of them are actually focused on buying other assets right now. I mean, obviously this creates a bit of a conundrum. I mean, right now you've got this massive credit leverage being unwound. It's centered in the U.S., but believe me, things are just the British banks got at least as stupid, if not stupider. Their leverage ratios are utterly ludicrous. They're pretty bad in Europe as well, although Europe is still, although they haven't had their equivalent of the FASB cave into Congress the way the American one did. They've always had a little bit more loosey-goosey standards the way they reported stuff. So I think the banks in Europe are probably in a little worse shape than they admit. There is a difference with a lot of Europe, though, outside of Britain and say Iceland and Ireland and Spain maybe. A lot of those countries actually do have, like Germany is the best example. It actually has a fairly good savings rate always had. They're a creditor country, not a debtor country. They have a fair amount of cash. Switzerland, for all the issues they've had with their own currency, is still a creditor country. They've got a lot of cash. I mean, there are places in the world that I think will help stabilize the world economy more quickly than some people fear. One thing before I go into the metals themselves, I want to explain why Dave and I feel the way we do about metals in general. It's not really that we're Pollyannas, which I know is what some of our friends in the business think. These two charts pretty much explain a lot of it. This one probably more than anyone. What this chart is how much of the world's growth, in other words, how much of the amount that's added to the world GDP every year, how much of that is accounted for by emerging economies, how much of it is accounted for by developed economies. And by developed economies, they're basically talking the G8. If you go back to 1984, it was roughly even, but it was about 55 developed countries, 45 developing countries. And of course, the developed countries collectively have, what, 20% of the world's population maybe? 80% of it's in the developing countries. If you take a look at how this has shifted in the last 25 years, it's a pretty significant shift. And this is before all the talk hit the fan here in the last 9 months. This was already well underway. We've gone from developed economies generating, their peak was actually in the late 80s at about 65%. It's now 20% of world growth. This year it's probably less than zero. The emerging economies got to about 80% of world growth. Now it's probably all of it this year. I mean, what there is of it's going to come from countries like that. It's not going to come from the G8. Now, when people that are skeptical about this stuff hear that, they say, well, okay, that's great, but all we're doing is shipping stuff to Walmart, so we're having a recession. They're having one. That's partially true, but only partially. This example here, the reason why I add this chart to it, if you take a look at this, this shows you emerging economy exports as a percentage of GNP. It's fairly high, no secret there. Developing countries generally get rapid growth by exchanging their low wage rates for income from higher countries. In other words, they use the wage differential to grow quickly. That's the easiest way to do it. It may not be the best way, but it's the easiest way, and it's the path that most of them take. But the important part of this chart that I want to make note of, and even though this ratio has grown, it's important to note that of this 35% in 2007 that was exports, 20% of that 35% went to other developed countries. It didn't go to the G8. The G8 is not the only customer for these countries. It's important to keep that in mind. So where do we go from here? I mean, I'm sure everybody at this show is talking gold, so I'm gonna be the odd guy out and talk about base metals a bit. Although I will talk about gold at the end as well. Basically, we're into cash and carry now. A lot of what happened in the fall, we saw enormous drops in prices. A lot of them went to, copper went to its cash cost. Most of the other base metals went below their cash costs, and by that I mean their average cost of production. There were two things driving that. One was simply, obviously, a demand drop. I mean, the world went to hell in a handbasket. Nobody wanted to buy anything. The other thing that happened with metals, and it's not really well known to people outside of the industry. I mean, if you look at something like copper, say you're a guy that makes plumbing supplies. You know, obviously, if you're tied to the construction business, you can imagine what kind of shape your business is in. You're looking around, you're trying to make pay. Well, what do I get here that I can sell easily? One thing this guy's probably got, if he's pumping out pipe all the time, is 5,000 tons of copper ingots in the warehouse. He can turn around and sell those right back into the LME, whatever today's spot price is, piece of cake. It's one of the easiest ways to raise money if you're in that part of the business. So a lot of the rapid warehouse stock rebuild you saw in the late last year, early this year, was actually not manufactured, but guys that had already bought it and were holding the inventory did be throwing it back into the LME as a cash, basically as a cash flow management method. One of the things that gives us a little more comfort than maybe some people have when it comes to this stuff is Dave and I grew up in the mining business. My father was a mining executive. Dave went and did geology. I did finance. We came together later and started doing the newsletter. One thing I can tell you is mine isn't all about boom and bust. You don't have to explain that to those guys. Anybody that's been a 30-year mining executive has been through about 5 of these things. So, I mean, they don't like them any more than anybody else does, but they've had to deal with them before. And one thing that actually impressed us, if that's the word this time around, was that the mining companies actually reacted very quickly this time. I mean, it may not feel that way to some people, but believe me, the speed at which the supply started coming off this cycle was really impressive. I mean, they did not waste any time. I think like a lot of people, they looked at how ugly it was last fall and decided, you know, we can't assume anything but the worst case scenario, and started shutting down anything at the high end of the cash costs got shut down very quickly. I'll just go to the next one to go into some of this stuff. I'll go into copper a little bit here, and then I wanted you to see a chart this long, because most of the charts that people throw out these days are like, they kind of start here. And to understand where we're coming from, it's important to see this side of the chart. I mean, this is the last cycle. This is the 90s, basically. Copper pretty much, I mean, that's what it did, right? It went down to, the low was about 55 cents. The high was about $1.10. And that's pretty much where it went until about 2003. This is a chart from the LME, by the way, which has nice long data streams with a charitable chart program, as you can see from the bottom. It needs a little work. This is about 2003. You had the first bounce up. A bunch of this was speculative, but only some of it. And it's the thing that I want to point out here. And right now the copper price is about here. The bottom on this copper price is higher than the top of that cycle. I know there's a lot of people that have been doing, decoupling, what decoupling, secular bull market, what secular bull market. A lot of the metals actually have not broken their lows, and that is uncommon. That's not, if I had seen copper go back to 60 cents, I wouldn't be touching any of this stuff. But copper actually bottomed out so far at $1.25, and we're fairly comfortable with the bottoms actually in.